All right, so hello everyone. This is Professor Wei again. In this video, I want to talk about time value of the money, which is a very essential quant framework for financial analysis. Okay, so in the last video, I used two experiments to motivate the philosophy behind the value. Okay? So there's a time component, there is a risk component. Remember that? Also, in the second experiment, I talk about the role of a financial engineering, which can lower the risk. Okay, so please refer to my last video, looking into the details. Okay, so in the third experiment, I want to give you three scenarios to motivate the notion behind the time value of money. Okay, so let's look at the first scenario. Just give you two options and see which one you prefer. $100 today versus $100, $120 today. Of course, as a rational decision maker or a rational human being, all of us prefer more to less. Okay? So I believe all of you will choose $120 today. There is no doubt in that regard. So how about the second scenario? $100 today versus $100 2 years from now. Okay, think about that for a moment. Well, let me tell you, in the past, most of the students, including myself, will choose $100 today. Why? Remember in the last video, we mentioned something called opportunity cost. So why you want to lend out $100 to others without being paid back, right? So there is no reason for you to do that. Well, you can argue, what if something happened regarding the required rate of return over the next 2 years? Probably your $100 will be depreciated. Well, if that's the case, well, probably the second option is going to be better. But let's just assume that's not the case. Okay, just let's assume we live in a risk-free world, and well, everything's certain. So obviously, all of us will choose $100 today versus $100 2 years from now. Okay, so it's kind of a straightforward. But how about the third scenario? $100 today versus to $120 2 years from now. Think about this. Okay, so there's sort of a $20 compensating your opportunity cost, right? So you're going to lend $100 to me, and I will pay you back $20 more 2 years from now. Well, which one do you prefer? 100 or 120 2 years later? Well, let's save this thing for a moment, okay? So by using this kind of scenario analysis, I want to throw out to you the notion of time value of money. So in a sense that there is always a sort of a monetary value attached to time. Okay, there is no reason for you to lend $100 to others without being paid back. So as a rational human being, we always expect some return on our investment or financing process, right? So $1 today is more than $1 tomorrow. Okay, that's because of the monetary value attached to the time, okay, which is constant. So let's delve into some examples to help you to visualize this idea and see under the scenario 3, which one is a better solution. Okay, sorry, which one is a better option. So before I answer the question, I want to introduce you the definition or the notion of a future value. So the idea of a future value is that you place yourself in the present and you look forward and see how much money you can get in the future. So basically, it's the cash value of the investment at some time in the future. Okay? So You stand in the present and look into the future. Let's take a look at simple example. So suppose you invest $100 today in your saving account, and given the interest rate or whatever required rate of returns to be 10% over a year or on the annual basis, how much you can get in 1 year. So in this scenario, under the future value and present value context, well, the notion is, so you have a principal of $100, which is your present value over a year of over a time frame of 1 year, which is the number of investment period, just one, and given the interest rate or opportunity cost of 10%, so you're going to evaluate how much you can get in 1 year. So you can see $100 principal times 1 plus the interest rate is going to be $110. In this case, you have a principal of this $100 and $110 have actually two components, principal and interest earned. Okay, jointly, this $110 is going to be your future value. So you place yourself in the present and look toward the future, you will get $110. Okay, so it's kind of a paired concept. So present value and future value is kind of a pair with the notion. Okay, so you place yourself in the present and look toward the future, and you can get $110 in 1 year. Okay, this is the kind of a numerical illustration of future value. So let's make the story a little bit complicated. Okay, so still you have $100 principal. What if you extended the investment period to 2 years? So what will you have after 2 years given the required rate of return or interest rate of 10% over a time frame of 2 years? So the answer is it depends on the way of compounding, okay? So the compounding essentially is the process of accumulating your interest on investment over time. Okay, so there are essentially two types of interest compounding. The simple interest basically is the interest earned only on the original principal. That's in this case $100. Compound interest, well, it's the interest earned on both the initial principal and the interest reinvested. So there's a component of the interest on interest. So the interest reinvestment actually matters a lot. If you look at this numerical setup, so under the compound interest scenario, okay, so you have $100 principal, and you are going to invest this amount of money over 2 years. So you have 1 plus 10% one time and 1 plus 10% second time. You are going to compound your interest 2 times over the entire investment horizon. Okay, so you will get $121 over 2 years with the compound interest scheme. So how many components over there? Well, you have, under the simple interest, you have $120, right? So in terms of the compound interest, you have $100 of principal and $10 of interest from first investment period, another $10 from your second investment period, and $1 of interest on interest. Okay, so this is kind of a different story with simple interest world. In finance, if, well, no one tells you, so we essentially assume it's going to be the compounding interest environment. Okay, so now if you go back to scenario 3, well, probably the answer, well, The answer is it depends on the scenario, it depends upon the interest rate, depend upon the compounding or versus the simple interest scheme. So it's really hard to tell whether it's, oops, let me move back to the slides. It's really hard to tell which one is better off, $100 today and versus $120 2 years from now. There are lots of information around that can navigate your decisions. Okay, so that's the third experiment. Well, let's move on to next slide. So in this slide, I present a graph to help you to visualize the idea of a future value. So the future value largely depend upon the investment horizon, basically the number of your investment period, also the level of interest rate, and of course, the principal. So this graph plots the return of a $1 over investment period of 10 years with different levels of interest rate. You can see the higher interest rate or higher required rate of return, well, the higher the future value, right? So that's kind of straightforward because you have more return on your investment. Obviously, over a certain number of years, your future value is going to be higher given higher level of rates. So let's take a look of the other end of the story, which is the present value. So the present value is going to be the current value of future expected cash flows discounted at a certain appropriate discount rate. So what does this kind of a definition entail? Well, so basically you stand in the future and look back to the present. Let's take a look of one simple example, okay? So suppose it's a single period case and let's say you need $400 to buy the textbook next semester, next year, and you can earn 7% of a required rate of return on your money, and how much you need to have to put up today. Okay, so essentially you are asked to solve a question like, given the future value of $400 and interest rate of 7%, the time frame is 1 year, how much you need to have solving for the present value, okay? Well, nothing fancy here. It's actually pretty straightforward. If you look at the equation over here, essentially you are going to solve for this present value proxied by this PV, and you just need to rearrange. You can see it's nothing more than you bring back this $400, a condition on the fact that there is a 7% of interest rate, you can get the present value of $333, okay? Later on, I will show you how to use the financial calculator to solve this type of a problem, okay? Now, let's take a look of another example. You want to buy a new car. Now you have $5,000. The car is priced at $68,500. If you earn 9%, how much you have to invest today to buy a car in 2 years? Okay, think about this. What are the necessary inputs for you to solve this problem? Well, so basically, you have $5,000 today, and the car is $68,500, which is your future value. Okay, given the 7%, sorry, 8% of excuse me, 9% of the interest rate. Essentially, you have the rate of return and future value. Now all you need to do is to discount back your future value to present, and you can see this amount is the amount you need to get your new car. Okay, so given the fact that you have already got 5,000, so you really need $76.55 conditioned upon this investment scenario. Okay, so that's kind of a quick example on the present value scenario, okay? So I do want to show you another graph to help you to visualize the pairwise the idea of a present future value relationship. So whenever you got the inputs of a present value, return, and the time frame, you can solve for the future value. Likewise, if you get the future value, time, and rate, you can do the reverse engineering and discount back all the future cash flow to the present. So in finance, this kind of mathematical design really give us a framework for us to conduct financial analysis both at the personal level and the corporate level. Okay, so essentially, whenever we want to evaluate an investment opportunity or evaluate whatever financial decision, we always want to forecast the future cash flows associated with certain investment alternatives. Okay, so for example, if a company want to finance a machine, want to invest on a machine, long-term asset, okay? So what we want to do is to forecast the profitability of this machine, basically to see how much future expected cash flow the machine can generate it over the next 10 years, and then bring back those expected future cash flow to the present using the required rate of return, and then we come out with a number which we call the present value or net present value to capture the the value of this investment opportunity. So this kind of a general idea can be applied to virtually all the financial valuation process. Of course, we need to get more details, but in this course, as long as you know the basic present and future value relationship, you actually made a huge process. I highly encourage you to use this kind of a framework to think about your future financial decisions. Okay, so $1 today is more than $1 tomorrow, given the certainty of the investment environment. Of course, when we introduce the uncertainty, the risks into our decision scenario, the dynamic will be changed. But that's a separate story. Okay.